Hey, my name's Josh Walker. I am one of the owners of a REIT investing, and today we're going to talk about a typical multifamily syndicated deal. So, in my discussions with investors who are brand new to syndications, most of the questions, and if there's some hesitation, a lot of it centers around them just not being familiar with what an actual deal looks like. I have invested in personally in about 40 of these types of deals, and a number of them have gone full cycle. So what I mean by full cycle is I invested, it ran its course, and then there was an exit. The asset was sold at the end, and so I'm no longer associated with that deal. It went full cycle, so I've got my full return back. So I can talk through this whole process in a fair amount of detail. So I figured it might be beneficial to just walk through a deal from the very beginning to an ultimate exit. And so we'll talk about we'll use a multifamily deal as an example. The reason for that is they're generally the most common. You see a ton of multifamily deals available out there. They're the easiest to understand and to build your knowledge level from. Multifamily should likely be the basis and the foundation of your understanding of syndicated investments. They have a little bit of everything, but when it comes to the four aspects that we evaluate in every deal, and those are cash flow, growth over time, tax advantages, and velocity, certain asset types lend themselves to being heavier on some than others, but multifamily tends to have a good amount of each. So let's talk about what happens first. So you've done the early work. You've become familiar with how these deals work. You've connected to some sponsors and some people that have deals. The absolute first step is you're going to get a deal packet. And so this will either be you've subscribed to an email where they email you when deals come out. That's how we work. Or maybe it's delivered through some sort of portal system, but you're notified somehow that there's a deal. The email may just have a few bullets in the body of the email that are about the deal and the sponsor, and you may have to request the packet. It may be attached. They may send it to you in a separate email, but one way or another, you're going to get this deal packet. Once you've got the packet, it's going to have the major highlights of the deal. It's going to have some details on the sponsor. It is going to include their historic results, and it's going to include information about the asset, where the asset is, the city and the state, what type of asset. Is it a small or large apartment? Is it a mobile home park? You name it. It's going to have a lot of detail about the asset itself. And then it's going to have some specifics about the asset. If it's a multifamily asset, it'll have the number of units. It'll have the type of units, how many one bedrooms, two bedrooms, and so on. It'll have what types of amenities. It will have information about the age of the units. If this asset has ever been upgraded, it'll have the cost of the unit, and it'll have some information about any value add that's going to come along with this. We are huge fans of value add multifamily. That's where a good sponsor can go in and renovate a lot of the units, upgrade the common areas, and add value to that asset. So for them to do that, ultimately they're going to have to increase the rents from where they are today after they renovate these units. So you're going to want to know, and you'll be able to see in this packet, how do these rents compare to the market. They'll have some information on the renovation plan. How many units do they plan to upgrade? Often it's all, but not always. Sometimes they want to upgrade half of them and then maybe sell it to somebody so there's still meat on the bone for another future end user. What are they going to do to the common areas? Are there going to be any additions? And are they going to add any kind of one off things like covered parking? Sometimes people add a dog park, things like that. On the flip side of that, so that's kind of the offense. On the defensive side, you're going to want to see what kind of detail there is on expense reduction. If they are buying from a mom and pop operator, which we highly advocate to find sponsors who purchase from mom and pops. The mom and pops can typically be very high on expenses, so there's a lot of room for them to come down. So see if that's noted. Another thing that's going to be included in this packet is some market research. So what's the average income in the area? What's the average rent in the area? Average housing cost? What are some nearby attractions? What's the population growth over the past few years, historic and projected? And what's the overall multifamily need? Another thing that's going to be included in this packet is what sort of financing the sponsor is going to use, what is the amount of bank debt, what kind of term is on that bank debt, and then what is the amount that they're going to raise. Another thing is going to be investment highlights. And these are just things that may be specific to this deal that are not typical, but something that they believe that you are going to like. There may be some strong tax advantages. This may be a very, very strong sub-market they've done a whole lot of research on within the greater market. And maybe the achievability of the value add plan is more so here than other deals you may have seen. So they'll throw some things like that in there, typically under some sort of highlight section. The other thing that they're going to show is the use of the funds. So how you can see how much is being raised, how much bank debt there's going to be, how much of that total amount is going to be used for the purchase, how much is going to be used for some one-off things like legal and title and escrow and fees. And there's a lot of things like that. Another thing is going to be the terms of the deal. So we've talked about this in the past. This is completely up to the sponsor, but they will spell this out. So we've talked about we're big fans of deals that have a preferred return. So a certain amount of the profit that goes to the investors before it ever goes to the sponsors, they will spell out what the pref is. It might be a 6%, 7%, 8% pref. Beyond that, they will spell out the waterfall. So once the pref has been hit, what is the split between the sponsor and the investors? And is there another hurdle rate? If once everybody achieves a 15% rate of return, is there a separate split? Maybe it's a 80-20, 80 going to the investors and 20 going to the sponsor until you get 15%, and then maybe it goes to 60-40. And then whether or not the distributions will be distributed monthly or quarterly should be called out there. That's not something that we care just a whole lot about, but you should know going in what that looks like. And then one of the most important things that you should focus on that should be in this deal packet is the pro forma. So these are the projected project and investor returns. Do not confuse the project return for the investor return. The project return is always going to be higher than the investment return, but the investor return, the project return is just what is going to be the overall return of the project. If somebody just went and bought it on their own, there were no investors, they kept everything, that's the project return. The investor returns, which is all you really care about, those are the returns that you are going to get. And note that the pro forma is different than the pref. We get this question a whole lot. Maybe it has an 8% pref, but year one might only be scheduled to deliver 6%. And people can get confused about that. The pref just means that's the percentage of the profits that are going to go to the investors before the sponsor gets anything. That does not mean that's where the deal is going to start. It might start out lower than that and build over time. That is pretty common. And then also note when the distributions are projected to start. It's not always month one. I've seen them happen on month 1 or 2. That's pretty rare. There's usually a 2 to 4 month lag where it allows the sponsor to close on the asset and then get a little work done, get their feet underneath them before they start making distributions. But I've seen them as long as a year to 18 months where they're going to do a whole lot of that value add on the front end and utilize a lot of that capital. They typically don't have to raise quite as much if they're going to delay the returns for 12 to 18 months. That's not always a bad thing to let the sponsor just focus on that value add and not distributions for the first 12 months or so. So that's the deal packet. Beyond that, we're assuming you're doing this deal, so you've decided to invest. So what happens now? You let them know by whatever method they request. You let them know that you would like to invest. You let them know how much. This may be through email, just an email response. Maybe you know the sponsor personally. You can shoot them a text, say, hey, reserve me some amount. Or it's often through some sort of a portal. Beyond that, they will send, you will send in investment docs with your bank and entity information. If you're going to invest through an entity, you'll send them that information because they need to know how to pay you. You have to send them your bank account information because they are going to send you monthly or quarterly distributions, and they need to be able to know how to get that money to you. And then you're going to have a funding date where you're going to wire the funds to the sponsor on a certain date. So you'll need to get that wire info. Um, let's see. I highly suggest creating a tracking mechanism for your deals and start it with deal one. I still use a spreadsheet. I have a column for each deal and I have a row for every month. So I can go to the deal and then I go down to November 23. The distribution was $555 for this month. I put it in. That way you can go back and see how the individual deals are performing without much work. When you get behind, especially if you end up in a lot of deals, this can be a bear to create on the back end. Let's see. Once the distributions have started, you should expect them to be pretty close to the pro forma projections in the early time. If they differ greatly from the pro forma within the first 12 months of projected distributions, that's not an amazing sign. Later in the deal, there's a lot greater chance that these can differ because stuff happens. I mean, who could have projected COVID? Maybe interest rates fluctuate greatly. Maybe they're going to refinance it. Over time, you would expect the deviation from the pro forma to the actual distributions to differ more and more. But early time, you should expect it to be pretty close. There's just not that much of an opportunity for things to change at that point. One of the marks of a great sponsor is great communication. So this doesn't mean constant communication or large amounts of communication necessarily. It means that they adhere to how often they said they would provide updates. Normally, this is either monthly or quarterly. Most likely, it's quarterly. Monthly is a whole lot of updates for a multifamily. There's typically not just a ton of changes month to month. And it means that they let you know about meaningful items in a timely manner. If there's a refi, if there's a potential sale, if they're getting more or less than the projected rent increases, things like that, they let you know in a timely manner. Know that there's a balance between appropriate communication and over communication. Until they know that a refi is secured, they probably shouldn't let you know that they're just working on a refi. All that does is get investors' hopes up, and a ton of refis they don't materialize for a number of reasons, and they don't really need to let you know about those kinds of things. It just becomes a roller coaster if they jump the gun until they've secured something like a refi or even a sale. A sale is a little more likely that they should let you know, hey, we're going to put this to market. We're checking the market. We are actively trying to sell this. That's very, very common. But until they have the deal secured, they're probably not going to give you a ton of detail on that. The first couple of years is when a lot of the real value add happens, and that's what the communication should be centered around, not just here's how much we're distributing this month or next quarter or whatever that timing looks like. They should be letting you know how many units did they plan to renovate by this time, how many have they actually completed, how do the renovation costs compare to what was actually projected, what are the increased rents post renovation, how do these compare to what was projected, how does the timing of the renovations compare to what was projected. All of those things are what drives an eventual successful exit, and you should not have to ask for that information. That's what's going on with the asset that you invested in, and that's the information that they should be steadily feeding you with likely quarterly emails. So once the renovation period has been completed, there will likely be a lull in activity, potentially a lull in communication, and rightfully so. At this point, rents should be up, distributions have likely increased, and the project is in what I would refer to as harvest mode, just bringing in an increased NOI or net operating income. Throughout the process, you can be comparing your distributions with what was projected and making sure you understand why, if they differ, why do they differ? Then they'll certainly differ by, maybe your distributions were projected to be $650 and maybe they're $625. That's not a big deal. But if the projection was 650 and you're receiving 350, reach out to that sponsor if they have not already let you know, here's why we're deviating so much from the pro forma, and they should be able to readily answer those questions. So post renovation period, now it's basically we're looking at a refi or a sale, or we know the reason that hasn't happened. If they're not investigating one of those two things, it's likely a long-term hold, but you should have known that going in. So even though it may have only been may only be 2 or 3 years into a projected 5 to 7 year deal, once the value add is complete, the goal should be to provide the projected returns to the investor. So there's kind of two phases, three maybe. One's the acquisition, two's the renovation period. Now it's deliver the returns. The goal for the whole thing is to deliver the returns, but once the renovation period is done, you can't deliver the returns until the renovation period is done. That's part of the business plan. Once that part of the business plan is done, though, there's nothing magical about a 5-year, 7-year hold. That was just the projection. Now it's all about how does that sponsor deliver these returns to these investors via whatever method that they can. Now keep in mind, you never want a sponsor forced to sell into a bad market, but they should be very willing to take advantage of a hot market by contemplating an early exit. It's possible that neither of these make sense, and that they should just continue to hold the asset and provide the current level of distributions. That's the beauty of these deals. Let's say the renovation period is done, and this is kind of the world we're in right now with some of the deals that I'm in. Interest rates have gone up a lot. It does not make sense for them to refi into this current interest rate world, and so it makes a whole lot of sense to just hold for the time being. That's the beauty of these deals, is that when the world isn't going exactly as everybody would have loved, you can just sit and continue to collect rent. So following all of that is going to be an eventual exit. At some point, it will make sense for the sponsor to sell that asset. So the sponsor should make you aware at that point that they are pursuing a sale and have some sort of projected timeline. Take these timelines with a grain of salt, especially if they don't have an active buyer. If they're just saying, "Hey, we're going to put this out to market," know that it could be 3 months, it could be a year. Take it with a grain of salt, but it's good to know that they're actively pursuing a sale. These can be tricky even once they get it under contract. There can be tons of twists and turns. Things typically do not go smoothly with these. This is a very large and expensive asset, and so a sale typically does not just go as smoothly as everybody would like, and you should expect that going in. It may, and that's great, but you know what you're getting into with these. They may go through 2 or 3 buyers before they have one that closes as expected. And beyond that, once they have the asset under contract, you should be notified and you should be made aware of the closing date. Once the deal has closed, you should be notified of the timing of your final distribution, and that's typically pretty quick after the actual closing date. I've seen it typically 1 to 3 weeks. Know that there's often some amount of the proceeds that's held back in case there are unexpected expenses post-closing. This can be held back for 3 to 6 months, but it's normally a very small relative amount relative to the overall proceeds that you're going to receive. And then post-exit, and really even before the exit, you should be thinking about taxes. And so find a tax advantaged deal. In an ideal world, this thing has doubled your money in somewhere around 3 to 5 years. So you're going to have some amount of tax liability. You should either have banked passive losses on the front end, or you should be actively seeking a deal that's going to provide for additional passive losses. So if you think about it, when you have taxes or passive gains to offset, the deal that can offset them inherently has an enhanced return. So even if you find a deal that doesn't have a projected return that you love, if it can offset these taxes, that deal already inherently has an enhanced return because you're not going to pay taxes that you would otherwise have paid. So build those tax savings into the returns of that new deal. And you can even do that on the front end if you're kind of banking them early on. And basically, that's it. These deals are as passive as deals can get. That's one of the reasons that we love them. There's a lot of reasons that we love them, but that's one of the main ones. That doesn't mean that you can't do some things to increase your chances of success and eliminate your tax burden. But that's what we call the active part of passive deals. And so I hope this has been helpful to you. I hope I've answered a lot of the questions that you may have, especially if you've never done one of these deals. Our goal is to provide as many people as possible with the knowledge and skills to be good at money. If this is a benefit for you, we would love it if you would rate and share our podcast. And you can also go to Arete Investing, ARETE investing.com, download your complete guide to syndicated deals, and get good at money.